Good afternoon, everybody. My name is Katie Ensweiler. I'm the Senior Marketing Manager here at VonLehman CPA Advisory Firm. Welcome to the first session of our series on operational checklists. In a minute, you'll hear from our partners, Fraternal Law and Favor & Company, as they will go over what they plan on covering on the sessions we have in August and October. A big thank you to them on the partnership for this series, as we would not have been able to do it without them. Some logistical items: we are recording the sessions. If there's anything that you do miss, we will be sending out a link to the recording later on today or tomorrow, as well as the contact information for Lauren, who will be our speaker today. If you have any questions, please submit them into the chat box, and we will do the best we can to get through them at the end of today's session. With that, I am going to call up Amy with Fraternal Law.
All right. Thank you, Katie. I just want to echo our thanks to VonLehman and Favor for your fantastic partnership on these, and thank everyone again for joining us. I see a lot of familiar faces, but for those that I have not had the opportunity to meet, I'm Amy Hebler. I'm an attorney with Fraternal Law Partners. A little bit about us really quick. We provide legal services on business matters specific to fraternities, sororities, your chapters, house corporations, alumni associations, foundations, so a little bit of everything. We have a broad range of expertise that includes real estate, housing, corporate governance, employment issues, tax, grant making, fundraising, stewardship. So pretty much if you have a legal issue, we've either seen it or seen something similar. Like Katie said, will be the last session in the series in October. We'll focus that on your legal operations audit. So that would include what you should be reviewing regarding corporate governance, policies, procedures, legal documents, and everything that I just mentioned. So again, thank you for being here, and thank you for Katie and Jennifer and Mark for partnering with us and Lauren on this.
Awesome. Thank you so much, Amy. Jennifer with Favor.
Good morning, everyone. Thanks to VonLehman and Fraternal Law for partnering with us to bring this content to you. And thanks everyone for being here and for investing in your organizations. I'm Jennifer Morris from Favor & Company, and we are excited to be a partner in the Organizational Checklist Series. And we're glad you're here for VonLehman's presentation today. Favor & Company has been working to ensure the longevity of the fraternity and sorority community since 1979. And Mark and I have both been personally invested in the fraternity and sorority community since we've graduated from college. We're happy to see many of our clients and friends here today. Mark and I will be presenting on August 16th. Staff and volunteers who work on your insurance renewal, if you communicate with college or collegiate or undergraduate chapters about health and safety, and those in the housing area will really benefit from our information. We'll also be at FEA for your access. Feel free to catch us at any time during the conference or stop by and say hi to us in booth 601.
Great. Thank you, Jennifer and Mark as well. When we send out the link for today's presentation, I will also include the dates for the August and October events, so you can go ahead and save the dates on those. So with that, I will go ahead and turn it over to Lauren, who will discuss accounting policies and procedures. Lauren.
Hey, thank you, Katie. For those of you who I have not met yet, my name is Lauren Kreutzinger, and I'm a senior manager with VonLehman & Company. I work in our assurance team, so providing financial statement consultations or audits, reviews, compilations, things of that nature that organizations might need on an annual basis, and then also consulting just on various financial related matters throughout the year. So just to kind of give you guys an overview of the series that we have here for you, kicking that off today. So we were kind of brainstorming with Fraternal Law and Favor, and there's so many things as you are managing your organization that you have to stay on top of. And a lot of those could be kind of accumulated into a list of things that you might want to keep in mind or just keep a radar on throughout the year, and then make an effort to do, a good run through of that checklist every year. So we were kind of brainstorming this idea, and we talked about, wouldn't it be nice to have some sort of an operational checklist that your management team could use to make sure that there's no balls that get dropped during the year. And we felt like with our expertise in the finance realm, Favor's expertise in the risk management and insurance, and then with Fraternal Law's legal expertise, we felt like we could put together a pretty well-rounded series that would help you as an organization develop that personalized checklist that you could use with, collaborate with others within your organization to use that to keep on top of all the things that you have to manage throughout the year. So the first part of the series, as Katie mentioned, is related more to those finance pieces. And we'll go through those today, but I just want to reiterate that this isn't necessarily like a boilerplate checklist that we're going to develop for you. It's to get you thinking of the things that are applicable to your organization, and maybe some things that we don't even mention, but it triggers something in your mind to say, yeah, that's a great thing to put on my list so that I'm not forgetting that at the end of the year. So to get this started, I wanted to talk about some of the annual filings and the tax forms that are required for a nonprofit organization and what those are. So not all of these will be applicable to everyone, but just to give kind of an overview. The first one I want to talk about is personal property. So most states, regardless of where you're at, have some sort of form of business personal property reporting requirement. I know in Indiana there is one, but they do offer an exemption for nonprofit organizations. It's just you have to file that request for exemption. But something to keep in mind is that if you're going to move to another state, for instance, or maybe you're trying to set up a new entity, or you're even just moving from one county to another county, you want to make sure of any requirements to file or update your records so that you aren't penalized for not filing. Sometimes those changes will trigger a requirement for you to file and check in. So if you're not sure about what your requirements are in your specific state, reach out to your CPA or even your attorney, and they can certainly help guide you in that direction. Okay, and then there is also, in most states, there's some sort of state level annual report for corporations. So Indiana, for example, requires a biannual filing with the Secretary of State for all corporations, including nonprofit corporations. So if it doesn't get filed, there is the chance that your organization would be administratively dissolved, which doesn't pose any immediate issues. But I know we just worked with an organization who was trying to set up a new bank account, for instance. When they went to do that, they requested the EIN number. They couldn't set the new bank account up because their organization had actually been dissolved. They had no idea that this had happened, and so trying to help them get that reinstated. It's not anything that's as bad as like getting or having your nonprofit status revoked, but there's a lot of paperwork and time that goes into it. For something as simple as filing a report every year or every couple of years, depending on what your state's requirements are. And where we see this happen, this dissolving of the organizations most often is at the local level. So with your collegiate chapters or the housing corporations at the local level, a lot of them are not aware of that filing requirement, or maybe that detail got missed when they were transitioning to a new set of advisors or officers and things of that nature. So we see that quite often happening at the local level. So something to keep in mind and communicate with your other organizations. And then these next couple forms, I'm sure are nothing new to you, but there are the federal and the state requirements for your annual nonprofit organizations tax filings. So there's a couple different forms. There's the main form, which is 990, which most of the national organizations would be filing. They're large enough to file that long form. There's a shorter form for some smaller organizations. So those are anyone with gross receipts under 200,000 and assets under 500,000. And then Form 990N is just called an e-postcard. Very little information gets put on this form, a one-page form, but the gross receipts have to be less than 50,000. So if it's a startup organization, or if it's maybe one of the local chapters, that's typically what they're filing. And then Form 990T is required for any nonprofit who has unrelated business income over $1,000. So again, if you're working with a CPA, likely they are vetting what you need and when you need it. The due date, we just had our first due date of the year. It's the 15th of the 5th month following year end. So for our December year end, organizations, their return was just due on the 15th of this month. There is an extension that you can file. It's an automatic 6-month extension. You just have to file a form with the IRS to extend that form. You get 6 months. And then if it's not extended, there are, of course, late filings. If you have a 990T and you owe, you could also have interest that on top of your penalties. And then some states do require the state form to be filed as well, in addition to the 990, and then some states just use the 990 itself. So it just kind of depends on where you're at. Indiana has an NP20 or an Indiana IT 20NP, which is the unrelated business income tax form. Ohio has an Ohio annual form, and these are also due along with the 990, the 15th of the 5th month. They also have the same extension. Late filing penalties and things like that vary. So definitely check with your state, with your CPA if you're not sure of your state's requirements, or if you're moving to a different state, just check with them or your attorney. I know Fraternal Law has a lot of knowledge in the 990 space as well. There is a new filing requirement for Indiana. So this NP20 form gets filed in 2022. And then after that, it's only once every 5 years that it has to be filed. So I know our CPA firm keeps track of that for our clients. So if you're not sure of what your schedule is, just reach out to your CPA and they'll likely be able to tell you when your next form is due. So something to keep in mind with these annual forms, they are available to the public. So something that I want to recommend as part of your checklist would be to take a good look at what is reported on your organization on these publicly available websites. So GuideStar or candid.org is one place where these forms are available for anyone to go look. You can use your EIN to look them up. You can use your name and then filter it by states and things like that. So any recently filed 990s will be available out there, and you can actually look through that public document. So it's important when you're reviewing the forms that your CPA is preparing for you, reading through that to make sure it is accurate, because that is something that, like I said, it's public. Anybody can go out there and look at that. So making sure you're adequately describing your organization, communicating your program service accomplishments, telling your story the way that you want it to be told. And making sure that you're looking through, there's the 990 has an extensive question and answer section, and it's really easy to check, yes or no, those questions, but to make sure that those are actually accurate. So one thing that we like to do with our clients is go through that pretty detailed list and make sure that we've got everything reported accurately, since it is available to the public. So getting into more of the financial statements, one important thing with new standards is kind of twofold here. You always want to be abreast of any new standards that are coming out. If you're working with a CPA on a regular basis, likely they're going to be giving you some warning ahead of time of anything that's coming out so you can prepare accordingly. But it's never a bad thing if you're setting up an annual meeting with them ahead of your audit or ahead of your tax return preparation. Make sure that you're asking if there are any new standards coming down the pike that you need to be aware of. The most recent one, which anyone filing for December or any year after that coming up, will be applicable for this new lease standard. And this isn't a lease presentation, so I'm not going to go into all the details, the nitty-gritty details, but it just a high-level overview of what this is going to do is essentially put an asset and a liability on your books that hasn't been there before, related to any leases that you have outstanding. So before, all you were doing was just reporting your expenses, and then typically you were disclosing the lease terms in your financial statement disclosures. Now you're actually going to see something change on your balance sheet. So getting prepared for that, we recommend that you're keeping an inventory of your leases and you know where the copies of those leases are. Each lease is different typically, so it's a good practice to keep that all contained in one spot. So if you don't already, I would recommend that you inventory your leases and gather all of those lease documents together. And then some things to keep in mind as you enter into future leases. There are exemptions to this standard. So if you're If you are leasing something, if you can do it on a short-term basis, that would keep you from having to record this asset and the administrative burden of tracking it. Those short-term leases are anything that's 12 months or less. So that's something to keep in mind as you enter into new leases. And then there's also been some recent relief for related party leases also. So I know, fraternities and foundations might have related party leases for the use of the headquarters, for instance. So some things to keep in mind there. Again, you can be exempt from applying this standard to your lease if it's a short-term basis, but you want to make sure that it's not in the lease itself. There's no terms that say that it's going to automatically renew or anything that indicates it's evergreen. You actually do have to write up and sign a new lease each year. So if that's something that you're interested in, I would add that to your annual checklist just to make sure that you're staying on top of those leases that you want to kind of use that loophole of being able to show that they're a short-term lease, but continue that documentation. And then moving into the funds that you might have for your restricted funds. These are anything where, if you think about the donor restricted funds that your foundation might be maintaining, so scholarship funds or endowment funds and things of that nature. Maybe your foundation has just a couple, or maybe there's 250 different scholarship and other educational type funds that are out there. So we recommend that if you don't already have an inventory of these funds, then create one. And then on an annual basis, make sure that you're updating that inventory of what funds you have, what the purpose is of that specific fund, and then any exceptions maybe that you have to your standard fund agreement. So some examples of those exceptions might be maybe a donor specified that they didn't want to be charged a certain fee, or they were going to max their fee at this amount. Maybe there's a minimum balance requirement that has to be maintained in the fund before you can start issuing scholarships, things like that. So having that detail all in one place is very helpful. I know with the audits that I work on with our foundation groups, we typically have something like this from our perspective. So if you don't have an inventory already, maybe reach out to your CPA to see if they have something that you can at least start with and then build upon that. With managing these funds, there's obviously some administrative time and effort that goes into that. And so you want to make sure that your administrative fees that you're charging to each of these funds is still adequate. Maybe you haven't updated those fees in the last 10 years, but obviously your labor fees and your rent and all of the operational fees that you have as an organization have gone up. So making sure that you're assessing those fees that you're charging to the fund is still adequate and still covering the cost that it's taking you to manage them. Then something else that we see quite often is where a fund might go stale. So maybe they're not, over the past couple of years, they haven't gotten any new donations. They haven't granted any funds out. The committee that was in charge of accepting the applications for the scholarship, reviewing them and awarding them, maybe that's kind of gone defunct. So take a look over the funds, make sure that everything is still fairly active. And if you do see some that haven't had a lot of activity, come up with a plan for those funds. Is that something that you can reactivate, or is there another purpose that you can direct those funds? Taking a look at the fund agreement, if you have one for that particular fund, might help direct your plan there. And then if you don't already have one, gift acceptance and a standard fund agreement, those are two important things I would recommend that you have, or at least start to develop. Gift acceptance policies will allow you to nicely turn down gifts that you don't necessarily want or can't handle. So, you don't want someone's estate home that you then have to pay property taxes on and sell, and all the administrative work that goes into that. So if you have a gift acceptance policy that strictly prohibits that type of a gift, that's always an easier way to get out of a donation and do it in a nice way, not to offend a donor. And then standard fund agreements, again, a lot of organizations might start to get quite a bit of scholarship funds that donors want to establish, but to have a standard fund that each one of those types of funds gets labeled under is very helpful. So you know that each of these funds are all the same. They all have the same terms. They have the same fees that are charged, etc. So to develop something that's pretty standard and boilerplate helps you administer those funds much easier. And then similar to the, in the same vein as these restricted funds, we also have board designations that you might have as an organization. And the difference between a board designation and a donor restricted fund is the donor's involvement. So the donor restrictions are set by the donor, and you cannot use that money for anything other than what they've described as the purpose. A board designated fund is something that the board determines what your funds should be used for, or a pool of your funds should be used for. And those designations are, you can adjust those pretty easily, as opposed to the donor restrictions, which take a lot to adjust any of those. So making sure that you understand what designations you have from your board and whether or not those need to be reevaluated for whether or not it's still applicable to the organization. So a lot of times we'll see a board designate something maybe for a specific event, or like a capital improvement project, or various things, and it's old and no longer applicable, but it's still shown there as a board designation. So making sure that you're reviewing those on an annual basis, just to make sure that they're still applicable to the organization and what the organization is doing currently. Those board designations should be made during board meetings, and then the specific purpose and the date of approval and everything should be documented in your board meeting, so that someone can refer back to those in the future to make sure that they're followed accordingly, or to remind them of what those were designated for. For 501c7 organizations, don't forget your set-asides. Those are specifically related to any earnings that you have on your investments, and you can set that money aside during a board meeting for future expenditures for educational or scholarship type purposes, to avoid paying any tax on those funds. But those are similarly voted on during the board meeting and designated specifically. So something to keep in mind too, as part of your annual review of your designations, is making sure that you still have plenty of liquid funds in order to operate the organization. You don't want to, having designated funds isn't a bad thing. You just want to make sure that your board hasn't over designated, so that you don't have a lot of liquid funds to work with. So if you do have an audit or a review or a compilation done where there's footnote disclosures, that's one of the required disclosures, is to detail out the board designation. So that's an easy place to look to see what you have right now. But talk to your CPA if you have questions, refer back to board meeting minutes and things like that to see any documentation of things that you might have related to those designations. And then another thing to keep in mind on an annual basis is inventorying your assets. So there are a couple different schedules that you might have already, or that I would recommend that you start. Your IT department most likely would already have a listing of what equipment has been assigned to different staff members, and maybe they have a serial number, like a sticker or something on a laptop that identifies that laptop in particular, and then there's record of who has that. So making sure that you have a listing of your equipment that's assigned to different individuals, and that could be, like I said, laptops, tablets, phones, starting there. And then there's also another listing that you might have, either your CPA, your auditor, or maybe even your CFO. They should be maintaining a depreciation schedule. So these assets might look a little different from what your IT department might have, because you haven't necessarily capitalized every cell phone or every tablet, printer, things like that, the small equipment that you might just expense out when you purchase it. But your depreciation schedule maintains those larger items. So if you own a building, it would have the land, the building, your HVAC, any build out or improvements that you've made during the course of owning that building, roof, parking lot, things like that. So making sure that you're updating that schedule for anything, both of these schedules, for anything that you've purchased during the year, anything that has been sold or lost or just generally disposed during the year, removing those from the schedule, calculating your depreciation expense that you need to record for the year. And then also both of these listings are a great place for you to kind of get an idea of what upgrades you might be needing in the future for budgeting purposes. So, our roof was 25 years old. It might, we might need to start looking at setting aside some money to budget for a new roof potentially on our building, or the HVAC equipment, or if you're looking at maybe upgrading your laptops or other type of office type equipment. So kind of having that schedule, seeing when everything was purchased, how old it is, can help you also with that budgeting process. And speaking of budgets, this isn't like earth-shattering news, but you are recommended to have an annual budget and have that approved every year. The board and management should be looking at that on a regular basis to just see where you're at compared to actual. Departmental meetings, I find that it's useful to see that everyone in each department understands what their budget is and how they're contributing to the overall organizational budget. So if you have a good accounting software, you'll be able to add that budget into your accounting software, generate reports pretty quickly and automatically to compare your actuals to your budget and enabling that. So again, I feel like this is a no-brainer, but just make sure that annual budget gets added into your operational checklist. And then from a risk side and internal control side, you'll want to do an annual risk assessment. So this could be kind of a, depending on your organization, how it's structured, depending on, how involved certain board members are and things like that. It kind of depends on how you structure this meeting. But whatever this looks like for your organization, the main thing I want to get across is that you should be looking at your fraud risks of the organization on an annual basis. So brainstorming, if somebody wanted to commit fraud within the organization, how would they do that? And then from that discussion, what policies and procedures should we or do we have in place that would prevent them from doing or committing that fraud or stealing from the organization? So brainstorming some of these things might help you determine what changes you might need to make in your policies and procedures, in your internal controls to address any of those risks. And then keep you updated. Doing this on an annual basis will help you catch anything that has changed since the last time. So have you hired or lost particular staff members or positions? Has your organization grown quite a bit and you have more employees that you could segregate duties across and maybe improve upon your controls? And then also it's important, having these types of meetings, it's setting that tone at the top, which is so important. So if you're having an annual meeting with your staff and you talk about fraud within the organization, risks that might come up, or if you are aware of anything or see anything, reminding your staff to contact this person, or this is the protocol that you would go through if you feel like there's any unusual activity going on, or if they, hear of somebody stealing from the organization, things like that. So the more that your employees know and understand, and in the back of their mind, if they know management is in tune to this type of activity, or just in talking about it in general, will help them feel more confident in bringing anything up that they see, or at least giving them an idea of who they need to go to talk to about it. And then, as I mentioned, internal controls. So evaluating the controls that you have in place and using that risk assessment to see where there might be some gaps in those controls. So some things to consider as you're looking at your controls. Have you clearly define the roles and responsibilities of the people that are involved, establishing a means to report fraud or any suspicious activity. So again, at that meeting, letting your receptionist know, how do you report something that you find suspicious? Who do you go to? Segregating the duties, so making sure that not one person is responsible for too much of a specific task. And then maintaining physical controls over the actual cash and any of your accounts, your bank accounts, who has access to those. Making sure that bank accounts are reconciled regularly. Monthly is preferred, but some organizations tend to do that more frequently, just depending on the activity that's going on. And then keeping business separate from personal. So making sure that credit card usage is strictly for business purposes only. Having a policy in place of, what happens if somebody does accidentally use their business credit card at the grocery store on accident, but maintaining the policies in place for that. And then having a code of ethics and expectations that are communicated to staff. So making sure your employee handbook is up to date, talking about ethics and proper business etiquette and things of that nature with your new staff, and then reminding staff regularly of those expectations. And then meeting with advisors. So something that we recommend to our clients to do on a regular basis is meeting with different pieces of your operation. So your bankers, do you have a line of credit currently? Do you maybe need a line of credit in the future? I've spoken with a couple of bankers recently, and they're starting to encourage their clients, even if you don't necessarily need a line of credit right now, you have good credit currently, and to establish that line of credit might not be a bad idea for any downturns or any recessions that might be on the horizon. Keeping that in mind for the rainy day that when you might need it, because if your credit starts to decline, it's going to be really hard for them to open that line of credit in that situation as opposed to your current situation. So talking with your bankers about that, kind of keeping that in the back of your mind. One thing that we've seen a lot of our clients do recently is if they have some reserves set up, or if they get a large donation or have some extra funds that they don't necessarily need on a liquid basis, utilizing those CDs and then the higher rates that are on those right now to set up a couple CDs that maybe are staggered. So maybe they have one that's 13 months, one that's 18 months, and then one that's 24 months, so that you're not tying up all of your funds in a longer term CD, but you're able to capitalize on some of those high rates as a short-term investment tool rather than just letting those sit there in a savings account earning next to nothing in interest. And then also your bankers can give you some great information on any of the new offerings that they might have, fraud protection, and any new things like the CDs and the rates that they might be offering. And if you're not satisfied with that banker or those providers, making sure that you're looking at alternatives or going out to bid for something new is always something that you should consider on a regular basis. I did work with an organization in the nonprofit space who was interested in putting their money in a CD, and they had another bank come to them as a marketing kind of ploy and said, hey, if you want to come over to our bank, we've got this great rate that we can offer you on the CD and yada yada. And so what they did was go to their current bank and said, hey, look, we are really interested in this, but we like our relationship with you. Is that something that you could match? And they did it. So having those conversations with your different advisors, in banking, investments, things like that is never a bad thing. From an investment standpoint, you want to take a look at those mix of funds that you have, your investment strategies on a regular basis, looking at your investment policies, making sure those are still adequate. Most of the organizations that I work with do have a specific advisor that they meet with on a quarterly basis or an annual basis. So just making sure that you're staying on top of them to have those regular meetings and make sure that you're checking in on your strategies, how things are going. It's not, sometimes those investment statements can kind of get above your head of, what's going on with my portfolio? What does my direction need to be? And having those conversations, the sit down meetings with those advisors can go a long way in understanding what changes you might need to make given your budget and the forecast of your organization. And then same with the three groups that are on this call today with the attorneys, CPAs, and the insurance, having those annual check-ins, preparing for any annual filings like your 990 and your audit review or comp, your annual renewals with your investment or your insurance providers and things like that. So meeting with them on a regular basis to make sure that you have the information you need to continue on through that year and plan accordingly. And then finally, to kind of lead in to the future sessions. So Amy had mentioned that she's going to be talking in their session in October about policies and procedures from that governance and operational level. My homework for you leaving this event and preparing for the next is making sure that you're getting those policies and procedures pulled together so that you know what you have, when were they updated last, reviewing them and seeing what's inside of them, what are you missing, and pulling all those together so that we can dive further into those during future sessions in this series. But some of the examples of ones that I'm talking about, I have my list over here of all the ones I wanted to mention to you. So some ideas: conflict of interest policy, a couple that I've already mentioned, your investment policy, employee handbook is also another great one to be looking over. We have in-house, we have some HR professionals that consult with organizations in reviewing those handbooks to make sure that they're up to date, that they're current with the language and things that are being used in today's work environment. Spending policies on your endowments, if you have those, things like that. So for your homework for this throughout the summer and all your copious free time, make sure you're reviewing those policies, pulling those together so that you can know what you have as an organization when Amy and her team dives into those in the future. And then another policy that we always like to communicate is your document retention policy. So this is just a snip of our branded policy that we recommend for your business files. So that's anything that you should keep permanently, 2 to 3 years and 7 years. I refer to this document all the time, and I'm sure Katie can make it possible that we can get this out to you guys too, because it's a great thing to just keep in your desk drawer of how long do I need to keep this piece of paper, and refer back to this. There's also a personal section of this form too that I did not include here, but again, I use it all the time just to know if I'm going through my files, can I shred this or do I have to keep it, a couple more years? So I think I saw a couple chats come through, but Katie, do we have any questions so far?
We did have one question come through. I messaged the individual and told her that you would contact her offline. She has a few questions that she wanted to run past you. And to circle back to your comment about getting the information to all the attendees, I'll send a copy of today's PowerPoint out to everybody. So that will be included in that as well.
Great.
It looks like we do have one question that just came through. We have been working with more and more local house corporations, and one thing we have noticed is that some are registered as a 501c2 entity and not a 501c7. What is the best process for switching the IRS registration? Is it a letter written on behalf of the organization to the IRS, filing a Form 1024, or something else?
I guess my question would be, were they specifically set up as a C2? Is that how they obtained their exempt status as a C2, or was it an error in filing as a C2? Because there are some, the purpose of a C2 organization is to just hold property. So if it's a housing corporation that is holding property, that could have been intentional. If it's something that was done in error, then that is something that I can research and look into to find out what the best way to correct that would be.
Okay, he did follow up and say originally yes, but they operate as a 501c7.
Okay, yeah, if you can Katie, can you get the contact information? I'd be happy to connect them.
Absolutely.
See that here now.
Yeah, and I'll jump in really quick. We've seen that happen, and I'm sure, Lauren, you guys have seen it happen too a lot lately, especially with the IRS switching to that online filing with the 990s. Of like 20, 30, sometimes 40 years ago, these house corporations were properly set up as C2s because that's all they did, right? They owned title of the property, they collected it, they turned over the income, but now they're doing more activities, the social activities, forcing them into that C7 designation. So we have seen that, and I'm sure Lauren has too. It's most of the time filing that 1024 to change your status to that C7, but we have been seeing that pop up quite a bit recently, and I don't know, Lauren, if you guys have seen that too, but I think it is because of that new electric online filing.
Yeah. Yep. I think that's what's becoming just, it's easy to do things incorrectly. And that's why it is so important to review your forms when you do have the draft ready from your CPA or from whoever is preparing it. So I would agree with you, Amy.
Thank you for chiming in, Amy, on that one. It doesn't look like we have any other questions. So it looks like we're going to wrap up a little bit early today. Lauren, thank you so much for your expertise and your presentation. Very informative. And as I mentioned, I'll be sending out a link to the recording as well as a copy of Lauren's presentation and her contact information to everybody later on today. I will also include the dates for the Fraternal Law and the Favor and Company events taking place in August and October. So with that, we will go ahead and give everybody about 15 minutes back in their day. Thank you so much for your interest. Fraternal Law and Favor, thank you so much for your partnership on this. And we hope everybody has a great rest of your week. Thank you.